Hi everyone. Thanks so much for joining tonight's webinar on Singapore REITs. For many REIT investors, the past few months have actually been a fairly volatile period where we saw the share prices actually recovering on anticipation of the US Federal Reserve rate cuts. But since then, we have seen the share prices coming down once again. So we have received many questions from investors around what is driving this decline in the share prices. What I want to go through tonight will be some of the key developments relating to the Singapore REIT sector. And then we will have ample time at the end of today's session for you to be asking your questions. Okay, so let me start by sharing my slides. Okay, so the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. My name is Gerald. I'm the founder of Beansprout, and we are a leading financial insights platform in Singapore that is licensed by the MAS. We provide insights and tools on Singapore REITs, stocks, bonds on our platform, growbeansprout.com. And if you want more details about some of the REITs discussed during tonight's webinar, do visit our website to find out more. Okay, so a few things that we'll discuss during today's webinar. The first will be what is driving the weakness in Singapore REITs. Next, we'll take a look at what is the prospects of the sector going into 2025. And last but not least, some of the things that I'll be looking out for the sector recovery to be convincing to me. Okay, so the first question that is at everyone's mind would be what is driving the weakness in Singapore REITs? So I think this chart would be something that has been discussed quite often. We have seen the share prices of Singapore REITs actually recovering since August this year. Okay, so this is an index which represents a benchmark of Singapore REITs, and the index actually recovered from August onwards all the way till mid-September in anticipation of the interest rate cuts by the US Federal Reserve. We did see the first interest rate cut coming through in September, but interestingly, the share prices of Singapore REITs have actually declined by close to 10% since then. And what we now see is that this index of Singapore REITs is actually just within 10% of its 2024 lows. Okay, so this might come as a surprise to many investors who are thinking that, oh, since the Fed is already cutting interest rates, we have already seen 2 interest rate cuts so far, and there's potentially more interest rate cuts to come. How come we have actually seen the share prices of Singapore REITs come down in the past few months? Okay, so we can dive a bit further into this. And this is where I wanted to first show what the latest US Federal Reserve interest rates are. Okay, so I think this is something that has been covered quite a bit in the media, in various financial blogs, and it is something that we do track as an indicator for interest rates, which is what the US Federal Reserve interest rates are. Okay, so I mentioned earlier that the interest rates have been cut by 2 times since September. But even with the rate cuts that we have seen so far, the US interest rates are still at a fairly elevated levels. This is because the US Federal Reserve has to bring interest rates up very significantly to be able to bring down inflation. Okay, now that we are seeing signs of inflation moderating, that has given the US Fed some leeway to be cutting its interest rates. Okay, so that is the backdrop and something that many of us are aware of. But what some investors may not follow as much would be what the bond yields are. Okay, and to me, the bond yields are a more clear indicator to let me understand where the share prices of Singapore REITs might be trending compared to just looking at the US Federal Reserve interest rate guidance. Okay, why is that the case? That is because for financial markets, they are typically forward-looking. So whether is it bond prices, share prices, or REIT prices, they would actually be pricing in what is expected to happen going ahead rather than what has already happened. So this is what we see for the US 10-year government bond yield. Okay, so in anticipation of the rate cuts by the US Fed, we started to see the bond yields coming down since May this year. Okay, so a fairly sharp decline all the way down to 3.6% if I were looking at the benchmark US 10-year government bond yield. Okay, so within a few months, we saw a fairly sharp decline. But what is interesting here is that following the rate cut, the bond yields actually moved up. Okay, so that is something that's very important to note, in that because bond yields and bond prices are forward-looking, they do not immediately reflect what has been announced in terms of the US Federal Reserve rate cuts, but more importantly, what is the expectations of rate cuts going forward. And what has really happened is that after the US started cutting the interest rates, what investors are now expecting is that the pace of the future rate cuts might not be as significant as what was previously anticipated. Okay, so maybe previously investors were expecting that there might be 5 or 6 rate cuts in 2025, but now we might be looking at fewer rate cuts, and that is actually driving the bond yields up because the expectation on future rate cuts has now decreased. Okay, so that is one very important thing to note, and hopefully for all of us who are at this webinar tonight, that is one very key learning, in that we need to track the bond yields, which have an impact on the share prices of Singapore REITs. Okay, so that is the 10-year government bond yield. If the example is not clear enough, I've also brought up the chart of the US 1-year government bond yield. And what we see here is a similar trend, where we saw the decline in the 1-year government bond yield from June onwards, reached a low of about 3.9% in September, but then since then, bouncing to 4.4%. Okay. Okay, so next we move to Singapore government bond yields. If you are someone who is buying the Singapore savings bond, then this might be something that you might also be aware of. We saw the fall in the average 10-year return of the Singapore savings bond in some of the past issuances, because the Singapore 10-year government bond yield has been coming down. Okay, but what you might have noticed is that for the past 2 issuances, including the latest issuance, the average 10-year return on the SSB is actually higher compared to the previous issuance. So you might be wondering, why is that the case, even though the US has just announced more interest rate cut? And that is really because of this chart here, where we see that the 10-year Singapore government bond yield has actually gone up in October and has stayed elevated in the month of November. Okay, so the Singapore government bond yield has followed the same trend like what we see for the US government bond yield. And once again, the elevated government bond yields has actually been a headwind to the share prices of Singapore REITs. Okay, so I mentioned earlier that it is important to look ahead, because what is most important now is not just what has already happened, which is the 2 rate cuts, but what investors are expecting in terms of future rate cuts. Okay, what we see here is that the probability of an interest rate cut in December has actually fallen to below 60%. Okay, so I just updated this chart today, and what we see, which is the leftmost bar here in dark blue, the probability of a rate cut in December has actually come down to below 60% from above 70% just 1 month ago. So clearly, investors have moderated their expectations of further interest rate cuts, which is why bond yields have actually bounced over the past 2 months. Okay, so you might be wondering, how does this actually impact Singapore REITs? If the bond yields were to stay elevated, if interest rates were to remain high, we know that this will impact REITs in a few different ways. So first and foremost, higher financing costs from the debt that they are holding can potentially lead to lower distributions if they are not able to grow their net property income sufficiently to offset this higher financing cost. Okay, these REITs hold on to various property assets, and if the interest rates are higher, the valuation of some of these property assets might actually decline, which will impact the book value of the REITs. Last but not least, as investors, we have the option to invest in many different assets. I know many of you are also investing in Singapore savings bonds, in T-bills, and one phenomenon that we have seen is that if the bond yields are actually high, say you're able to get a T-bill at a fairly good interest rate of say 4%, and that is seen to be relatively risk-free, then it might actually reduce the likelihood of investors wanting to take the risk to be buying a higher risk asset like Singapore REITs. Okay, so if the bond yields were to stay elevated, we might still see a lot of money being put into Singapore T-bills, into Singapore savings bond, rather than to buy other asset classes such as Singapore REITs, and that might once again impact the share prices of Singapore REITs. Okay, so I've discussed a few potential impacts from the higher interest rates and how they may impact Singapore REITs. At this point in time, we can just do a quick quiz to make sure that we understand how these higher interest rates can actually be impacting the share prices of Singapore REITs. So one, REITs have higher financing cost. Two, the value of properties owned by the REITs may decline. And three, investors may sell REITs as lower risk assets, such as government bonds, may appear more attractive. Or for all of the above. Okay, so you can put in your answer into the chat, and we can see whether this is something we understand in terms of how higher interest rates can potentially impact Singapore REITs. Okay, I see quite a number of replies already. Quite a number of people who have answered for all of the above. So yes, the answer is all of the above. We see that higher interest rates can impact REITs in many different ways, which is why with the bounce in the bond yields, the concern that interest rates may remain higher for longer, they may actually lead to headwinds for Singapore REITs if the bond yields remain elevated. Okay, so that is one of the key factors that has actually brought down the share prices of Singapore REITs. And we will dive deeper into what are some of the other reasons. Okay, so that is the macro overview. For myself as a REIT investor, I always like to start from the macro overview. And to me, interest rates is something that I will keep track of very closely because that can impact the entire sector. Okay, but having looked at the overall trends in interest rates, as investors who are doing a deep dive into the sector, we also then need to look at the fundamentals of the Singapore REIT sector. Okay, so this is where we have often shared the Beansprout REIT investing checklist. This provides a few key indicators that I would typically look at when deciding whether or not to be buying a REIT and adding it into my portfolio. So to me, it comes down to three key things. The first would be the fundamental strength of the REIT, whether it has a good quality sponsor, whether it is able to earn a good rent for the assets that it holds, and that is being reflected in the occupancy rate in terms of the tenant mix. Next, we can look at the financial strength of the REIT to make sure that the gearing levels are not too high. It is able to repay its interest as well as principal from the borrowing that it might have. Last but not least, I want to be able to get a good dividend yield from the REIT. I want to be able to buy the REIT at a good valuation. So I'll also be looking at things like the price to book valuation of the REIT, as well as the dividend yield I'm able to attain. So with this as a backdrop, I wanted to go and discuss more around what are the fundamentals of the different REIT subsectors at this point in time. Okay, for REITs, there are many sectors that we are familiar with, retail, hospitality, office, industrial, and data centers. What I'll do is I'll look into each of these subsectors in more detail to actually share what is happening in each of these different subsectors. Okay, I will start with retail because I know that is something that many of us here tonight follow very closely. Whether you are actually going into a shopping mall to buy your groceries on your way home from work tonight, or whether is it something that you go with your family for your meals on a weekend, we can always check out what are the recent trends relating to some of these shopping mall assets held by the REITs. Okay, so what I always start with would be the retail sales data in Singapore. This gives me an indication of what are the consumer spending trends like and whether consumers are spending more compared to the previous year. What we have seen here for the latest retail sales data in Singapore that's come up is that for the month of September, it grew at 2% year on year. This is an improvement from the month of August, but generally what we see is that it is in positive territory, but not something that is growing at a very fast pace. Okay, so that is the headline level. What I'll also do is to dive deeper to understand what is driving these trends in retail sales. Okay, so this is where we have the latest data to be able to analyze further. So I shared earlier that the total retail sales grew by 2% year on year. On a month-on-month basis, it actually grew 0.4% in the month of September compared to August. But what is very interesting to me from this chart is that actually, if you take out motor vehicles, the retail sales in Singapore declined by 1.4% in the month of September. Okay, so that might actually be something that is concerning because of the fact that people are not spending as much as before, and then we need to dive deeper into why that is the case. You might be wondering, oh, how come we take out motor vehicles from the analysis? Why do we want to be taking that out? Is it selective use of the data? And that's something that I wanted to share with everyone on the webinar, in that the reason why when we are analyzing REITs and taking out the motor vehicles component in looking at retail sales is that how many cars are sold in Singapore typically don't impact how the shopping malls perform. You don't buy your car in a shopping mall, and in most cases, it is being driven by a few other things such as COE prices. So as a result, it is not a good indicator to understand what are the latest consumer spending trends. Okay. But what is interesting to me is that if I look at what are some of the key segments that can then impact the rental income from the shopping malls, things like your departmental stores, your wearing apparel and footwear, your recreational goods, the retail sales has actually declined compared to the previous year. Okay, what has effectively helped the retail sales to still be being supported would be things like your supermarkets and hypermarts. So what we see is that the more resilient parts of consumer spending are things that we have to be buying in any case. So maybe some of you might be using your CDC voucher. Maybe we are not cutting back on things like your bread and butter. So as a result, what we see for the retail sales for supermarkets and hypermarts is actually still growing on a year-on-year basis. But some of the more discretionary stuff like departmental stores, watches and jewelry, it appears that the spending has been cut compared to the previous year. Okay, so one additional thing that I'll often check would be the report by some of the larger REITs to be able to confirm what we have seen in terms of the retail sales data. So what I've done here is to check the latest announcement by CapitaLand Integrated Commercial Trust. We know that they own a lot of shopping malls in Singapore. including names like Plaza Singapura, Raffles City. So that will give us a good indication on what are the general retail sales trend in Singapore. And what we see here is that if I were to look at the tenant sales, for the entire retail portfolio in Singapore, it was down by 0.2% year on year for the first 9 months of this year. Okay, so that is quite consistent with what we have seen for the retail sales data in general, in that it is actually fairly lackluster if we were to take out the motor vehicle sales. What is also interesting to me is that if I were to break down between suburban malls and downtown malls, there's also a divergence in terms of the trends, where for suburban malls, it was still growing at 1.4% year on year, even though for downtown malls, it is down by 1% year on year. Okay, so suburban malls would be malls that you might be familiar with, the malls that are close to the heartlands, where there are more F&B outlets catered towards the residential population, while for the downtown malls would be malls in Orchard as an example, which are also dependent on tourist arrivals to be able to drive sales. So this is consistent with what we saw earlier, where some of the more resilient segments like supermarkets and hypermarts are actually still doing okay, while for some of the luxury items, they have actually started to see some signs of a slowdown. Okay, so how has that actually impacted the rents that the retail malls have been able to earn? I have put out the chart around the rents for retail malls here, and generally they have been quite flat, no significant increase or decrease. And that is consistent with what we saw in the retail sales trends earlier. Okay, so for example, the overall retail rental index in the third quarter was up by 0.3% in the third quarter compared to the second quarter. And if we were to look at it compared to the previous year, then what we saw in the third quarter of this year is that it was down 0.3%. Okay, so no significant movements here. Effectively, the rents have been pretty much flat because of the fact that retail sales is not growing very strongly, but at the same time, there is no significant pressure on the retail sales as well. Okay, so in a nutshell, that is what we see for the retail segment. Generally a segment that has been fairly stable and probably more resilient around the suburban malls compared to the downtown malls. Next, I'll go into one segment that is very closely linked to the retail segment, which is hotels. I mentioned earlier that the downtown malls have been impacted by the tourist arrivals, and we can see what are the latest trends towards the hotel segment in Singapore. Okay, so what I will typically start with to analyze the hotel sector would be the tourist arrival numbers into Singapore. Okay, so this is data from the Singapore Tourism Board. What we see here is that for recent months, effectively, we are still seeing growth compared to the previous year in terms of the tourist arrival numbers. So as an example, for September 2024, with the F1 race in Singapore, the tourist arrivals was at 1.27 million for the month of September. This represents close to a 10% increase compared to the previous year, where it was at 1.13 million. Okay, so it is still growing, but the trend here is that it is not growing as fast compared to the post-COVID recovery period. Okay, so if I bring you back to, say, 2022, the improvement here is very clear, where because of the post-COVID reopening, because of the pent-up travel demand, there was a very sharp increase in tourist arrival numbers, especially into the second half of 2022. The trend continued into 2023, but into 2024, effectively, the trend has tapered off. Okay, maybe with the exception of March 2024, when Taylor Swift had her concert in Singapore, and actually help to bring a fair amount of tourist arrivals. But apart from that, we see that the increase in the tourist arrivals has actually slowed down. This is what we see in terms of the forecast by the Singapore Tourism Board. For 2024, they are expecting that the total tourist arrivals into Singapore would be in the range of 15 to 16.5 million, compared to the 13.6 million tourists who arrived in Singapore in 2023. Okay, so still increasing compared to 2023, but compared to the very sharp growth that we saw post the COVID recovery, it is clear that the momentum is slowing down. Okay, so this has actually impacted the revenue that the hotels are able to earn on their hotel assets. One key indicator that I would be tracking would be the revenue per available room, or the RevPAR, and this is a term that is often used by the REITs with hotel assets. Okay, what this actually tells us would be for every room that is available, how much revenue they are able to earn from it. And what we see here is that, okay, if I were to look at the more recent months, the year-on-year increase in the RevPAR is actually close to 0%. Okay, and what this means is that compared to the previous year, the RevPAR is at about the same levels. Compared to what we saw in 2023, especially early part of 2023, when the RevPAR was growing at high double-digit levels, there is a clear slowdown in the momentum around the recovery in the tourism sector. Okay, so that will effectively impact how much further improvement in the revenue per available room the hotel asset owners will be able to enjoy from their existing assets. The next sector that I wanted to talk about is office. Again, this is one sector that we can observe very closely, especially if you're working in the CBD area. We can see what is the demand for the office space, whether there are a lot of empty offices around, whether there are new office spaces that are coming up. So what I wanted to share here would be the office space vacancy rate, which is the percentage of the office space that is not occupied. Okay, so we want this number to be as low as possible, which tells us that most of the office space is actually taken up rather than being vacant. But what has actually happened over the past 2 quarters is that the vacancy rate for the downtown office space has actually gone up. If I were to look at the first quarter of this year, it was at 7.9%, but in the third quarter, that has moved up to 10.3%. Okay, so there is more office space that is now not being occupied, and that will in some ways put pressure on the rents that the asset owners will be able to enjoy. So this is what we see here. In terms of the office rental index in Singapore, it actually came down 0.5% in the third quarter compared to the second quarter. Okay, you might be wondering why is that the case? Because when there is more office space that is not occupied, what the tenants will typically do is that they might shop around and look for other office space that can be seen to be at a better location, or they might negotiate harder with the landlords to be able to get a better rent, and that will typically put pressure on the office rentals. So this is what we see for the entire portfolio of office space that is available in Singapore, which declined by 0.5% in the third quarter compared to the previous quarter. You might be wondering what is driving the increase in the office vacancy rate, and that is really a factor of the increase in supply that we see for office space in Singapore. Okay, so this is the demand and supply chart. And what is interesting to me is that for the first 9 months of this year, the office supply actually grew by 0.5 million square feet. Okay, if this office space that is coming up can be absorbed by new tenants, then that is typically not an issue. But what we saw in the first 9 months of this year is that the incremental net demand was actually flat or zero. Okay, so in other words, there's no net new demand for office space in Singapore. And with the supply that has come up, that has actually led to the vacancy rate for the office space actually going up. What is also interesting is that if I look ahead into 2025 and 2026, there appears to be a continued increase in the office supply in Singapore. In 2025, you have got Keppel South Central at Tanjong Pagar that is coming up. And then in 2026, we have the 𝗕𝗲 redevelopment at Beach Road that is also coming up. So while both of these two assets are not at the core CBD area, they are at Tanjong Pagar and Beach Road respectively, the increase in office supply can still potentially present a headwind to office rentals if there is no significant growth in demand that is coming through from either existing tenants or from new tenants. The next sector that I wanted to talk about is industrial. I know this is one sector that many investors are also interested in because it is one sector that has done very well, especially after COVID. With the growth in the e-commerce demand, with the post-COVID supply chain bottlenecks, we have actually seen a lot of demand for industrial space, such that some investors have also shown interest in buying some of these industrial assets themselves. So what I'll do is I'll try to break down what are some of the latest trends within the industrial segment. For the industrial segment, it is a bit more complex because we have a larger range of assets that are available, whether they are factory space, whether they are business park space, whether they are warehouse space. But what we do see here, compared to some of the previous sectors that I talked about, is that they are actually at a more healthy level in terms of the rents that the landlords have been able to enjoy in the past few quarters. So using the multi-user factory rental index as an example, in the third quarter, it grew by close to 6% compared to the previous year. Even compared to the previous quarter, the rents in the multi-user factory space actually grew by 0.6% compared to the second quarter of this year. Okay, so across most of these subsectors, we see that the growth in the rents are still healthy. But what I wanted to highlight is that the rental growth has actually slowed down compared to the growth that we saw in 2021. Okay, so this would effectively put the data in a chart form. I hope it is able to better tell us what are the latest trends in terms of industrial rents. So I start with the chart on the left, which shows the rental index of factories. So what we see here is that in 2022, 2023, the rental index actually grew at a very fast pace as a reflection of the growth in e-commerce demand and also the supply chain bottlenecks post-COVID. But if I were to look at the most recent quarter, then effectively the year-on-year growth has actually slowed down significantly compared to in 2022 and 2023. Likewise, this is what we see for business park space, where in fact the rents have come down compared to the previous quarter. Okay, so you might be wondering why is that the case, especially for business parks. You might have read some of the headlines relating to, say, Changi Business Park, Mapletree Business City, where what we see is that the vacancy rate has actually increased within the business park space in Singapore. So the vacancy rate is actually now at above 20%. And that is once again presenting a headwind towards the rents that the asset owners are able to enjoy. Thankfully, the vacancy rate for some of the other asset classes like the multi-user, single-user factories are still fairly healthy. And likewise, that is what we see for the warehouse space as well. Okay, so while the current rents for most of the industrial subsegments are still fairly healthy, just one point that I'd like to highlight is that, again, as investors, we need to be forward-looking. We are not just looking at what has already happened in the past. And if there's a few things that we need to learn from tonight's webinar is that we can look ahead to see what is going to happen 6 months, 12 months, and 2 years down the road. What we see here is that while the rents for industrial space has been fairly healthy so far, one point that I would definitely take note of is that there is a fair amount of supply for industrial space that's coming up over the next 2 years. Okay, so if we were to look at a warehouse close to 0.7 million square meters of space that's coming up, and likewise quite a lot of single user factory space that's coming up as well. So if there is no significant growth in demand that will take up this incremental supply, that will drive up the vacancy rate of the industrial space and once again put pressure on the industrial rents. Okay, so far, you might be thinking that I haven't shared much good news. I know we are coming to December and everyone is in a more positive mood going to the year end, whether is it because of the year end holidays or just being able to take some time away from work. But one thing to take note of is that generally for most of the REIT subsectors, there are some headwinds in some form of another. And that has actually led to the share price pressure on the Singapore REITs because of the concerns around the fundamentals of some of these subsectors. So on top of the higher bond yields that we have seen, because of the concerns around the rents that the different REITs are able to enjoy, that has provided additional headwind towards the share prices of Singapore REITs. But there is one sector that we still see doing fairly well, and that is the data center segment in Singapore. Okay, so I know some of these data center REITs have been in the news recently because of various acquisitions, and their share prices have been more resilient compared to some of the other subsegments. And I wanted to bring up some charts to explain to you why that is the case. So if I were to look at data center assets in Singapore, the current utilization rate is actually close to 100%. Okay, so because of the growth in demand from some of the cloud usage, because of the increase in demand coming through from AI, there is actually a lot of demand for the data center assets in Singapore. If I were to look at the chart on the left here, there is actually also a fair bit of supply that's coming up from 2025 to 2027. But the difference here is that they have been absorbed by the incremental demand that we see in the market. Okay, so some of these data center assets can be pre-committed in that even before the data center has been completed, you already have anchor tenants or other high quality tenants that have already committed to wanting to take up this space. And that is what we see here for the data center assets that are going to be completed over the next few years, in that they have already been pre-committed, which is why the utilization rate for the data center assets are expected to remain close to 100%. So that in a nutshell would be the various sector performance and what are some of the key things to look out for, which can impact the performance of REITs with exposure towards the different asset classes. Against this backdrop, you might be wondering, so what should we do as a REIT investor? We are facing the situation where there's uncertainty towards the interest rate direction. based on what we see around the demand and supply trend for some of the key asset classes, there appears to be some headwinds going to 2025. So how should we think about investing in Singapore REITs? Okay, so to make it very simple for everyone who is watching this webinar, to me, I will take a 3-step process to be able to find the best Singapore REIT that I want to be including in my portfolio. So given our discussion earlier, we saw how important interest rates are in driving the performance of Singapore REITs. So the first thing that I'll do is to check the latest interest rate expectations. If I am confident that, okay, maybe interest rates are close to being cut, or that there is potential room for interest rates to be cut more aggressively, then I will start looking at good Singapore REITs that I can potentially add into my portfolio. So this is where I will start to screen for Singapore REITs and look for some of the best ones that I can then consider. Okay, so maybe after shortlisting some of these REITs, I might narrow it down to maybe 3 to 5 REITs that I think are worth considering. I will then do a deep dive into each of these REITs. I will show you step by step how I will go through the process, starting with the expectations on interest rates. Okay, so I shared earlier that we know what the Fed has done so far, which is the 2 interest rate cuts. And what is most important is to look ahead and be able to check what the expectations on future interest rates are. So this is where a tool might become helpful for us to track what are the latest expectations on interest rate cuts. I commonly use the CME FedWatch tool. That gives us an indication on what number of rate cuts are expected over the upcoming months. And that will give me an indication around whether investors are very positive on upcoming rate cuts. So this is the table that shows the probability of rate cuts in the upcoming Federal Reserve meeting. You might see a lot of numbers here, so don't be intimidated by the numbers. You just follow me to look at the bars that are highlighted in blue, because that will tell us what is the interest rate that is the most likely based on current expectations. Okay, so if I were to look at the upcoming December meeting as an example, investors are assigning a 56% probability for the interest rate to be then at 4.25 to 4.5%, which is 0.25% lower than the current interest rate. So what this means is that investors are expecting that there might be one rate cut of 0.25% in the upcoming December meeting. What is important is then to see whether the eventual outcome matches up to this expectation. Okay, if investors are assigning a high likelihood that there'll be a rate cut, but then if a rate cut doesn't happen, then that might once again bring bond yields up higher and put pressure onto Singapore REITs. If we were to look at 2025, then what we see here is that the most likely scenario is that there might be 2 rate cuts in 2025, potentially one in the month of May and maybe another one in the month of October. So what we can then take from this is that if the 2 rate cuts happen, then effectively that is in line with what investors are expecting. If for some reason or another you are expecting that rather than 2 rate cuts, we might see 4 or 5 or 6 rate cuts next year, then what this means is that the rate cuts are going to be more aggressive than current expectations. And in that case, we might then see sentiment towards the Singapore REITs improving. But on the other hand, if there are no rate cuts happening at all, then that might once again put pressure on the share prices of Singapore REITs. So if you want to be tracking all of this, once again, you can track this using the CME FedWatch tool. Okay, next we can look at screening for Singapore REITs. So if I am then interested in buying Singapore REITs, you might be wondering, how will I be able to choose the best Singapore REIT for my portfolio? So this is where I wanted to introduce you to the Beansprout REIT Screener tool, where you will then be able to find and shortlist some of these REITs. So let me now share my screen where I'll bring you through how I'll be using this REIT Screener tool. Okay, so some of you might be familiar with the Beansprout website. We provide you with various analysis on Singapore REITs, as well as other asset classes like stocks and bonds. And we also provide various tools as well. One of the tools that many of you have asked for is this Singapore REIT Screener, where amongst the 40 plus REITs that are listed in Singapore, you'll be able to screen them based on certain metrics. So what we have put here would be things like how much upside there is to the consensus share price target, which is what the average of the analyst forecasts are. Okay. I have also included various metrics such as the dividend yield, the price to book valuation, the gearing ratio, because some of you have indicated that those are things that you look at when deciding whether or not to buy a REIT. We also have things like the sector, so whether is it office, retail, industrial, and so on, because some of you may be looking at just investing in REITs within a particular sector. But based on what we have discussed earlier, most of the different REIT sub-segments actually face some form of headwind, which is why maybe in this case, we won't start by looking at the sector because of the fact that there isn't one particular sector that might stand out at this point in time. But on the other hand, if you're, for example, very positive on the industrial sector, because of the fact that e-commerce might be structural in terms of affecting the demand for some of these industrial assets, then what you can do is to potentially start by looking at the industrial sector. Okay, so against the backdrop that I discussed earlier, where no industry stands out in particular, maybe what I'll do instead is to look at the valuation of the REITs to see whether there are some REITs that might be trading at fairly distressed valuation. So what I'll do is I will sort the REITs by the price to book valuation, which tells us what is the current market price of the REIT versus the book value of its entire portfolio of property assets. So a lower price to book ratio will effectively tell us that for every dollar that these property assets are worth on their accounting books, investors are only paying 47 cents or 55 cents for what is in the accounting book. Okay. So OE REIT as an example, trading at 0.47 times price to book, Suntec REIT 0.55 times price to book, CDL Hospitality Trust at 0.57 times price to book. Okay, so maybe from here you might want to dive deeper into OUE REIT to be able to understand the REIT a bit better. Okay, so we see the share price of OE REIT, same trend as what we saw for the Singapore REIT index earlier, effectively having a rebound ahead of the US Federal Reserve meeting, but having a pullback thereafter. Okay, you'll be able to analyze various trends based on the checklist that I mentioned earlier, whether is it looking at the occupancy rate, the gearing ratio, and then be able to then look at some of the valuation metrics, including the dividend yield, as well as the price to book ratio. So what we see here, for example, if I want to look a bit closer into the dividend yield of OE REIT, I'll be able to see what the latest dividend yield is and how does that compare to the historical average. Okay, so for example, if I'm looking at the dividend yield of OE REIT currently at about 7%, this is quite close to the historical average. And what this tells us is that it is not particularly cheap or expensive compared to the historical average. It is quite close to what the sector on average is trading at. So in this case, you might want to then think about whether this dividend yield is something that you are comfortable with, given the fundamentals of the REIT that we discussed earlier. Okay, so I'll go back to looking at the slides to then think about the framework that we can then use in terms of analyzing the Singapore REITs. Okay, so I went through with you the Singapore REIT screener. I mentioned the checklist that we'll be using earlier. And to me, it really comes down to two things: whether the REIT is able to grow or maintain its distributions, because we want the REIT to be able to sustain the dividend payout for us to enjoy a steady flow of income as an investor of this REIT. Next, we also want it to be able to pay us a good dividend that would effectively compensate us for the risk that we are taking in buying this REIT. Okay, so once again, going back to these two key questions that I'll be asking to be able to be comfortable in buying this particular REIT. Okay, you might be wondering that, okay, the analysis that I shared earlier is very complex. You might not have the time to be able to do so because you might be busy with your work or family. So one of the ways that we can then be able to still gain exposure to the REITs would be through a REIT exchange traded fund. Okay, if you're not familiar with exchange traded funds, effectively, it is traded on the exchange, but with a ETF, I will be able to gain exposure to a basket of REITs, and that allows me to actually diversify my portfolio in a very simple way. What we see is that there are quite a number of different REIT ETFs that are listed in Singapore. The REIT ETFs offer a dividend yield of above 4%. And if I want to look at different ways that I can compare this REIT ETF, you can go to the Beansprout article and look at how we compare the different REIT ETFs to be able to choose the best one for our portfolio. Okay, so in summary, we have gone through quite a lot today. I think one of the key takeaways that we can have from tonight's session is that apart from just looking at the headline interest rate changes or what the Fed interest rate announcement is, we can also be tracking bond yields to give us an indication around what is the latest expectation around interest rates and how this can then potentially impact the share prices of Singapore REITs. Okay, what we have seen is that investors have moderated their expectations for rate cuts in 2025, currently just expecting 2 further interest rate cuts next year. And with that, Singapore REITs are now trading within 10% of their 2024 lows. I've gone through the various REIT subsectors, including retail, hotels, office, industrial. And what we have seen is that most of these different subsectors would face a mixed outlook, whether is it because of demand issues or because of supply issues. So how does this impact us as a REIT investor? What is most important is then for us to be able to look for the REITs which are able to grow or maintain their distributions and at the same time offer us a good dividend yield. If it is very difficult for you to be analyzing the individual REITs by yourself, if you don't have the time to be doing so, but if you wish to still gain exposure towards the REITs, then one of the ways that we can do so would be through a REIT ETF. Okay, so in a nutshell, that is what I have to share with you on the Singapore REIT sector today. If you find the session helpful and you want to gain access to more REIT-related resources, do visit our website, 𝗵𝗲𝗄𝗏𝗏𝗏𝗏𝗏, where we have regular insights on the latest REIT developments, as well as various tools for you to be able to better analyze your REIT portfolio. Do follow us on the various social media channels as well, including subscribing to our YouTube channel. So with that, I'll thank you for participating in tonight's webinar, and I hope to see you again soon. Thank you.